Behavioral finance is a fascinating field. It combines psychology and economics. It helps us understand why people make irrational financial decisions. Traditional finance theories assume people are rational. Behavioral finance knows we are not. Our emotions and biases influence our choices. Imagine you buy a stock. The price drops. Do you sell or hold on? Behavioral finance says you might hold on, hoping it goes back up. This is called loss aversion. We feel the pain of a loss more than the joy of a gain. Behavioral finance matters. It explains market anomalies and bubbles. It helps us make better financial decisions. By understanding our biases, we can avoid costly mistakes. Our brains are wired for survival, not always for sound financial decisions. We rely on mental shortcuts called heuristics. These shortcuts help us make quick decisions under uncertainty, but they can also lead to biases. For example, we tend to overestimate our abilities. This is called overconfidence bias. We might be overly optimistic about investment returns, or we might take on too much risk. Another bias is framing. How information is presented influences our choices. We are more likely to buy a product that is 80% fat-free than one that is 20% fat, even though it's the same product. Understanding these psychological factors is key to making better financial decisions. Overconfidence can be beneficial. It can boost our self-esteem and motivate us. However, in finance, overconfidence can lead to excessive trading and poor diversification. We might believe we can time the market or pick winning stocks consistently. Studies show that investors who trade frequently tend to underperform the market. They incur higher transaction costs and often make emotional decisions. Overconfidence fuels this cycle. It's important to be aware of the risks of overconfidence. Seek advice from financial advisors. Diversify your portfolio. Don't let emotions drive your investment decisions. Section 4. Herd behavior. Following the crowd can be costly. Herd behavior is a powerful force. We are social creatures and we look to others for guidance, especially in uncertain situations. In finance, this can lead to market bubbles and crashes. Think about the dot-com bubble in the late 1990s. Investors piled into internet stocks, driving up prices to unsustainable levels. When the bubble burst, many lost significant amounts of money. Following the crowd can be tempting, but it's important to do your own research. Don't blindly follow the latest investment trends. Make informed decisions based on your financial goals and risk tolerance. Section 5. Loss aversion. The pain of losing is twice as strong. Loss aversion is a powerful bias. It means we feel the pain of a loss more intensely than the pleasure of an equivalent gain. This explains why investors hold on to losing stocks longer than they should. They hope to avoid realizing the loss. Loss aversion can also lead to risk-averse behavior. We might avoid investing in the stock market altogether, even though it offers the potential for higher returns. This can be detrimental to long-term financial well-being. Recognize loss aversion in yourself. Don't let fear of losses paralyze you. Focus on your long-term financial goals. Remember that investing always involves some degree of risk. Section 6. Making better decisions with behavioral finance. Understanding behavioral finance is empowering. By recognizing our biases, we can make more informed financial decisions. Here are some key takeaways. Be aware of your biases. We all have them. Acknowledge them and take steps to mitigate their impact. Don't chase returns. Past performance is not indicative of future results. Invest for the long term. Diversify your portfolio. Don't put all your eggs in one basket. Seek professional advice. A financial advisor can provide objective guidance and help you stay disciplined. By applying the principles of behavioral finance, you can improve your financial well-being and achieve your financial goals. Remember, knowledge is power.